In today's video, I'm going to be giving you a guide to rental yields. In simple terms, rental yield measures the return on investment from the rental income of a property. It's calculated as a percentage relative to the property's value. There are two forms of yield. You have gross and you have net yield. Gross yield does not take into account expenses and costs, whereas net yield does. Gross is obviously easier to work out, whereas net yield takes a little bit more time and is a little bit more tricky, as you need to know all the costs and expenses involved with the property to get the true net yield. So gross yield is good to use in the initial instances. So maybe you're looking at multiple properties, different areas, different locations, and you can use that to quickly work out where will be a better location or property to focus on. Once you've narrowed it down more specifically and you want to find out the net yield, then you will factor in all the costs and expenses to work out your net yield of the property. Bear in mind, yield is just one form of working out the return on investment of a property. And this is to be used if you're looking at the long-term profitability of a property via the rental income. For example, if you're looking to buy, renovate, and then sell on, what we call a flip, then you may be less concerned with yield as a calculation. How to work out yield? So to work out gross yield, you take the yearly rental income for the property and divide it by the property's value. So to make it simple, let's say your rental income was £5,000 per annum and the property value was £100,000. You would divide £5,000 by £100,000 and then times that by 100, giving you a gross yield of 5%. To work out the net yield, we then have to deduct the costs and expenses. So for example, if the rental income as before was £5,000 and the costs of the property on a yearly basis were £1,000, you would do £5,000 minus £1,000, which gives you £4,000, divided by the property value, which is £100,000 in this instance, times by 100, which gives us a net yield of 4%. And you may be wondering what costs and expenses you would need to deduct. So the typical expenses will be mortgage repayments, agency fees, for example, letting agent, ground rent, service charge, and insurance. They're the main typical ones that you would be factoring in. Why is rental yield important? Well, it's one of two main ways to make money through property. The other is by the increase in the property's value over time, which we refer to as capital appreciation. Now, rental yield is important for investors to look at when working out the profitability of their investment and future investments that they're potentially looking to buy. And a rough guide on what you should be looking at yield-wise, I tend to find most investors will be happy with an average yield of between 4 to 7%. That'll be sort of the bare minimum that they'll be looking at. And then anything 7 to 10% is classed as a good rental yield for a standard property investment. I hope that's been helpful. And remember, if you have any questions, please feel free to get in touch.